Hello and welcome to Moneylife News and Views. I'm Debashis Basu. For much of the past 2 years, a comforting story has taken hold in the Indian stock markets, and that is that foreign portfolio investors have sold relentlessly, and yet share prices have held up. I mean, they're not crashed. Similar kind of selling in the few occasions in the past would have led the market to fall by 15, 20, 25%. Now, what is the reasons for this? The reason is, as everybody knows, domestic mutual funds are stepping up to buy. They are getting money from what is called systematic investment plans of retail investors. Now, the implication is that FIIs are selling and the retail investors are buying through mutual funds. So can more than match the money that is going out of India by FIIs selling. India is no longer dependent on foreign capital. Retail investors have arrived, absorbed the shock, and stabilized the market. Now, the numbers appear to support this claim. Since September 2024, FPIs have been heavy sellers, culminating in record net outflows of that is $19.6 billion. Domestic institutional investors, meanwhile, bought nearly $96 billion worth of equities. Foreign ownership in NSE listed companies has fallen to levels last seen 2 decades ago, while mutual funds have steadily increased their share. Now, this is largely true, but this popular narrative rests on a questionable assumption, that is, FPIs and domestic mutual funds are buying and selling the same stocks. Are they? Foreign institutions remain overwhelmingly concentrated in India's largest companies. Those are mostly in Nifty 50 or Nifty 100. Companies like Indian banks and consumer companies and software exporters and so on. Now, domestic mutual funds also buy those stocks, but they are far more focused on mid and small cap stocks. And what appears to be one market absorbing away from foreign selling is in reality two different markets moving in different directions. Now, all this of course, has a background because Indian stock market was opened to foreign institutional investors way back in 1992. Following year, India's first private sector mutual fund opened for subscription. So both got an entry into India at the same time. India's domestic mutual funds, there was of course UTI and State Bank of India, but I'm talking of private mutual funds. But over the next 2 decades, FIIs completely dominated the Indian stock market through the stagflationary 1990s, dot-com bust of 2001, the big asset-led boom of 2003 to 2007, global financial crisis of 2008. In all these periods, it's the FPIs, foreign portfolio investors, who have set the direction of the Indian stock market. When they sneezed, as they say, we caught a cold. At their peak, in FY 2014, they owned 22.1% of all stocks listed in the National Stock Exchange. Throughout this period, concerns were frequently raised that Indians were not participating adequately in the wealth being created by their own stock market. Foreign investors appear to be capturing the bulk of or the disproportionate share of the gains in the stock markets. Then something changed. The Indian mutual funds, whose ownership had remained stuck below 4% for years, began attracting far larger inflows after demonetization. While foreign ownership hovered around 21%, domestic ownership steadily rose. Following the 2-year bull market between September 22 and September 24, the divergence became much more pronounced. FPI ownership fell to about 17.45% by March 2025 from 21 to 17.5, and then to 15.8 very next year, that is March 26. This is the lowest level of foreign institutional investing in holding in India since March 2006. So it's a 20-year low. Meanwhile, domestic mutual fund ownership rose to 10.4%. The March quarter of 26 highlighted the trend. A record $19.6 billion in annual FPI outflows, nearly $14.2 billion occurred during the quarter following Donald Trump's tariff announcements in the Gulf War. Over the same period, domestic institutional investors purchased $95 billion of equities. To many observers, this represented a structural shift in India's capital markets. The country had finally developed a domestic investor base capable of offsetting foreign outflows. Minister Nirmala Sitharaman repeatedly argued that retail investors had become a shock absorber, reducing the market's vulnerability to capital flows. There is truth in this claim, as of course the data shows, but only up to a point. There are little wrinkles in the story that we need to know. Aggregate ownership data conceals an important distinction. FPIs remain heavily concentrated in the largest companies. At the end of FY26, 92% of their NSE holdings were in the top decile of listed firms by market capitalization. Domestic mutual funds were somewhat more diversified, with 87.8% in the top decile and a larger allocation to smaller companies. Now, the difference becomes clearer when fund flows are examined, because this data that I gave is just about Nifty 50 and Nifty 500 and not about many smaller companies which are outside these two indices. Now, how can we capture what's happening there? To know about that, we have to figure out where the money is mandated to go by through SIPs. During January to March 26 quarter, equity mutual funds attracted more than 90,000 crore of net inflows. Mid-cap and small-cap schemes alone received 26,000 crore. So 26,000 crore of 90,000 crore is almost 30% was meant for mid-cap and small-cap. Remember this. There's another category called large and mid-cap. They attracted another 11,600 crore. Now, there is also pure large cap funds. Remember, large cap is where FIIs are buying and selling mostly. So, large cap funds received only about 7,000 crore, and this money also was meant for passive products, that is, index linked products, index funds. So, in other words, retail investors through SIPs are putting more money into schemes that invest in small and mid caps. If they do that, mutual funds will go and invest in those shares. They cannot invest too much in other categories. That's the primary mandate, to invest in small and mid caps. Now, this is precisely the market segment where the foreign institutional investors have a limited exposure. They're mostly in the large caps. This is what explains one of the curiosities of the past bear market, which has been a flat market last year. Since September 2024, that is almost 1.5 years, the Nifty has fallen about 6.7%. It's not able to go up because of relentless selling by FIIs of Nifty 50 stocks. Yet the Nifty small cap index is down only 3.8%. And wonder of wonders, something that never happens in a stagnant market or a mild bear market, Nifty microcap index has beaten both these two and is down only 2.9%. If domestic investors were merely absorbing foreign selling, which is in large caps, one would expect similar performance across all market segments. Instead, the divergence reflects differing ownership structures and differing sources of demand. I'm not at all suggesting that FPIs and DMFs inhabit entirely separate universes. Both invest across market capitalizations. And I've mentioned this before, I'd reiterate that, but the preferences are different. FPIs remain concentrated in mega cap banking, software, pharmaceutical companies, many of which delivered modest earnings growth. Domestic fund managers, buoyed by relentless SIP inflows, have increasingly gravitated towards fast-growing businesses in pharmaceuticals, defense, precision engineering, power equipment, and other mid-cap sectors. So if retail investors choose to put money in a small cap fund, the fund manager has to invest in small cap stocks. This is how the money is going there. The result is that FPI selling and DMF buying, that's a mutual fund buying, have not been mirror images of one another. So foreign investors have largely been exiting one part of the market, while domestic investors have been enthusiastically accumulating another, subject to some overlaps. Now, that's one aspect of the story. And there's another much bigger flaw in the argument that retail investors have replaced foreign capital. It's one thing to say that retail investors are a powerful force in terms of market prices, but it's quite another matter to say they have replaced foreign capital, because foreign capital, when foreign investors sell Indian stocks, they want dollars. They sell in rupees, they take the dollars, and which then puts pressure on the rupee. So exchange rate becomes weaker. The rupee becomes weaker. Now, when mutual funds buy to so-called to absorb, even if assuming that they are absorbing exactly what FPIs are selling, they use rupee savings, and they get and they have they're deploying rupee capital, right? So there's no inflow of foreign exchange. There's an outflow of foreign exchange when FPIs sell. When domestic mutual funds buy, there is no inflow of foreign exchange. So there is no support to the Indian rupee. So in other words, DMF mutual funds can offset the impact of FPI selling on equity valuations, but they cannot offset its impact on the balance of payments or currency. Now, this matters because one of the historical concerns about India's dependence on foreign capital was not merely stock market volatility, but also the risk of sudden pressure on rupee when foreign investors head for the exits. In fact, the weakness of the rupee over the last 2 years is substantially due to FPI selling, and no amount of domestic mutual fund buying can do anything about it because we are buying in rupees, we are not buying in dollars. In short, India has certainly become much dependent on FPIs than before thanks to SIPs, but the idea that retail investors have simply absorbed foreign selling is flawed in multiple ways. Now, if you did like this video, do subscribe and do share, and thanks for watching.